You're good. It's Friday.
It's Friday. Happy
I
Friday!
don't think it started.
I think we're on. I think we're live.
Now we're live.
It
No.
should say something.
It says live.
Okay.
Nova Wealth Management is live. Hi everybody.
Hello.
Yes.
Beth and Steven are forcing me to do this.
Wow. And we're not even here next week. And the week
That's a good
after was
point.
Thanksgiving.
That's true. I'm just
So-
saying I did not have a chance to get ready. Should I just put this hair back? Oh my gosh, this is
It's okay, Amy. Focus.
I mean, I'm working, right? I'm busy back there helping people and working and in meetings and I'm like, hey,
I'm not doing anything. So.
Okay, so we're this is Finance Friday. This is the show where we give you the information you need to help create, grow, and protect your wealth. Sorry, here we go. I'm Amy Novakovich.
I'm Stephen Harrington.
And what are you, Stephen? Let's brag on you today.
You
Let's
do a
put
good
you
job.
on the spotlight.
Go ahead.
Okay, so a CFA is less than 2% of financial advisors. Less than 2%. Well, he's also got a CFP. So the fact that you have a CFA and a CFP, what does it even give a statistic, Beth?
No.
For how many advisors have that combination?
I should probably check.
So even though I'm mad at you right now, I'm gonna brag on you. You know, because that's just the kind of Jesus person I am, okay? We're
Hallelujah.
gonna love. So today, definitely time to talk because it's towards the end of the year. We're talking tax loss harvesting, and just hold on a minute if you don't know what that is. If you do know what that is, then hopefully we're going to teach you something a little bit higher level today than what your basic knowledge is, maybe. And so we are going into the end of the year. So what you can do is tax loss harvest, and we do this every year here. We get about October-ish, start looking at opportunities. But right now the market is, well, actually it rebounded today. You're saying we might get an opportunity before the end of the year for it goes to go down. Beth, I don't know if I'm hitting this microphone and then it's going.
No, you don't hear it when you hit it.
Okay,
So you're okay.
just making sure.
We'll edit that out.
So first of all, let's back up. Let's discuss for those that may not know. A gain, a capital gain. So when you make money on something, you owe capital gains taxes. So real estate, probably the biggest example.
Selling a business.
Selling a business.
Selling real estate.
Selling
or a stock.
a stock, an investment in your account that you started here, it grew here, and you owe taxes on the gain. Now the good news is capital gains rates are not income tax rates if it's long term. So what we can do is we can be strategic about when we take gains. You don't just go selling things because you're going to cause yourself unnecessary taxation.
In a year, long term is a year plus a day.
I'm just gonna ask you.
A year plus a day.
Yeah.
Yeah, that's true. 366 days. Yeah, so what we like to do is harvest losses because losses offset gains. So if you have 100,000 in gains, I'm just making it up. If you can find, now nobody wants to lose money, but we all have things that fluctuate. So if you can stay invested but also take the taxable loss, this is a good thing. So do you want to kind of explain at a high level? I feel like I'm already getting in the weeds.
Yeah, so you explain the
I'm
game.
going to share this out while you talk.
Perfect. So when you, let's say you have
And I explain
a,
how losses offset gains, but people get so confused about, well, I can only take 3,000 a year.
I was going to touch
You know what I
on
mean?
that. yeah.
Address that.
So let's say you have a portfolio and there's two stocks in this, and stock number one goes up $100.
Are we live, Beth? I don't see
Yes.
that we're live.
You're live.
Oh, really? All right,
There we
I'm
go.
sharing it out. Oh, there we are.
I sure it.
So stock one is, let's just call it Target, goes up $100. But then let's say you have another stock, let's call it Home Depot, and it went down $100. You want to sell that first stock at a gain, but you don't want to pay tax on it. You could sell your Home Depot stock that's gone down, and when you sell that, you have what's called a capital loss. So now you have $100 of a capital loss. You could sell Home Depot. You can buy Lowe's, a similar company in the same sector. So that way you keep that equity exposure, but you've sold something at a loss, but you've also sold something at equal gain. You don't owe any tax. It offsets.
Or
Now,
in real estate, I think another popular.
you have a good example for
I love a good
2022.
example because it was just so fun to save her all this money. So in 2022 was a great time, and we'll have this again. But 2022, the stock market was down, but the real estate market was flying. So what would happen is people would sell their properties, right? But in their stock accounts, we could take losses to offset the gains on a property that they would sell. So I had a client that she was going to have like $900,000 in taxable capital gains on this property because it was a second home. I think it was above and beyond it was not her personal primary residence.
So it's all taxable.
All taxable, yeah, because if it is your primary residence the last 2 of the 5 years, you get the section 121 exclusion, which is $250,000 per person. So if you're married, $500,000 on capital gains.
That you can exclude.
That you can exclude. So I was able to sell and generate losses in the account, stay invested. I just moved over to different companies, kind of like Steven said, except these were funds. So I can just move on into something else, stay invested, but just take the loss, just make the trade. So we stayed invested as if we didn't make a trade, but we made the trade just to realize the loss to offset the gains on the property. It was so cool. Hundreds of thousands of dollars in
Zero
taxes
tax.
saved. So fun.
And to touch on what you were saying earlier, a lot of people get confused with this capital loss. So let's say last year I sold a position and it was $100,000 loss. So I have $100,000 loss that I have in my back pocket, but I haven't sold anything at a gain. Well, what can I do? Well, on my taxable income, I can use $3,000 of that capital loss every year to offset my ordinary income. Can't use all 100,000, but I can use 3,000 of it.
Right.
So now my loss moving forward is 97,000. And then let's say another year goes by and I don't have any gain to offset it. I can use 3,000 again to offset.
This is why it's important to have somebody who manages your gains just as much as your losses. Because if you have losses to take and we have gains, we want to sell a position, maybe we just don't love it anymore. Maybe it's appreciated so much that now it's like a huge risk to the portfolio because you've got a concentrated position in this one position. So maybe we want to sell some, but you haven't been selling any because you're like, I don't want to owe the taxes. If you've got losses to take, you take the gains, you use the losses to offset the tax. Or there's different brackets of capital gains. So there's the 0% tax bracket, there's the 15% tax bracket. So you get up to an allotment of gains before you even owe taxes on them. So you need somebody looking at these gains, especially by year end. It's got to be done by December 31. So you don't get until your tax filing deadline. It's a calendar year thing. So it goes from January 1 to December 31 for 2025. You'd have to take your losses or take your gains by December 31, even though yes, you get until April to file your taxes, or if you file an extension, even later. But you do not get all that time. Now you're in 2026. You cannot go back in time unless you have a time traveling secret.
And we'd be buying NVIDIA if that was the case.
It's true. Years ago. Yes.
Oh. I think another key point that we should have started with as well, just to hammer home, is that this has to be in taxable brokerage accounts.
Oh, that's a great
You
point.
can't do this in retirement accounts like 401ks, traditional Roth IRAs.
But this is why retirement accounts are retirement accounts. They're tax deferred. And a lot of people don't understand the whole tax deferral thing too. It's like, no, you can sell as much as you want in a retirement account and you don't owe the gains tax. That is the tax that is being deferred. Also income tax as well when you make the contribution. But all the growth, the deferral is the capital gains tax. So yes, you're hammering home the point that you have to be in a retirement.
They call it non-qualified accounts or brokerage investment accounts. That's where we use the strategy.
I don't like that right there. An IRA can be a brokerage account.
Yeah, that's true.
But a lot of people do call it a brokerage.
Yeah.
Then I get the statement and I'm like, oh, your brokerage account is an IRA. Like it's just a title, guys. So I could have
Call it
3
non-qualified.
checking accounts. Yeah, non-qualified. I could have 3 checking accounts, and one is joint with Steven, one is myself.
Money's gone.
Yeah. One is, Nova's account. And they're all checking accounts, but all 3 are taxed differently because they're different titles. One's a business, one's a joint, one's an individual. So it's the same type of account, but different title. For tax purposes. So one is a retirement account and one is a non-retirement account. We are not going over.
Okay, I'm looking.
Miss
We're
Beth.
only at 10.
Just listen.
So
We have a tendency to go.
we do. So it has to be, you're looking at trust accounts, joint accounts. In Florida, we have joint tenants by the entirety, which is we should do a live on tenants by the entirety.
A lot of people get
Florida,
confused
we
on
have
that.
different states that
Rights
have.
of survivorship.
Yeah, rights of
common,
survivorship.
Common law states.
Yeah. We should do that a different day. Anyway, we're talking about gains today.
Unless we have time to do it now.
No.
No, okay.
One thing at a time, Stephen, one thing at a time.
So again, anybody that's thinking of selling property, anybody that has bought Nvidia and and they got a lot of gains in Nvidia, send this video to them. Share this out, please, because this hopefully will help them. Or they can give us a call and we can tell them what they can do. We can develop a tax strategy unique just to them. That would be fun.
So just a little teaser for maybe a future video is we're doing this capital loss harvesting, which is really important. But then there's also kind of a new term, the capital gain harvesting.
Scott kind of
Yeah, I think Scott did coin
I
that,
think
but I think it's genius because a lot of people are leaving potential 0% tax rate on the table by not doing capital gain harvesting. So we got to look at capital gains both ways, the
Yeah.
loss side as well as the gain side. So you
Maybe
need someone
there might be some capital gains that you could take and not even owe any tax.
zero.
Leave it on the table. If you go to the next year, you lost it. You don't get to carry that
Leave it
forward.
on the table.
Right. So I would say that is a good little, you said a teaser?
A little teaser for a future
For a
video.
future on capital
Future finance friend.
gains. We would need like a chart. We need your, what do you call, not vision board, vibe board.
My vibe board.
Yeah.
Yeah, I can send it up right here.
We could do all kinds of writing. Anyway, I think this is good. I think we've covered just like the basics of, and the reason why this is timely now is because again, we only have 6 weeks left in the year. You need to be doing this
crazy.
now by December 31 on top of a whole bunch of other things, right? But this is something that you have to set a meeting with either our firm or I would say accounting, but they don't know your investment portfolio. So it has to be somebody that knows both taxes and investments in the same place, which is why we kind of do it all here in-house, right?
Exactly.
That's
That's what we do.
The government's
We
open.
do it all.
Can we name you EA yet?
Not
Oh,
yet.
yeah.
I'm still waiting.
Still
So
waiting?
I've
Okay.
passed all the tests for the IRS
So bad.
certification, but yeah, still waiting on that. But,
Very good. Well, you guys have an amazing weekend. We are so grateful for you being here. And again, if you are an advisor that maybe you do feel like you know both taxes and investments, but you're at a firm that really they're just an investment house, or
That's why I came here is because I felt so handcuffed. I'm not going
Right.
to name names for the prior investment
Right.
house, but I just felt so handcuffed as far as what I could do.
Yeah.
And here I've got so many ideas that Jim and Amy are like, oh yeah, let's hear it. Let's instead
do
of
it.
before I would say, hey, I have an idea. Nope, sorry, stop, stop right there.
run it by our compliance. Not at this point, run it by our compliance department. So yes, if you're one of those advisors and you want to give us a call so we can discuss any opportunities, we'd be totally open to that. But I am going to get off camera with.
And we'll be here next week, so
Right.
So it'll be just you
you'll
two.
be stuck with me
You
and
have an appointment right now, so I think it might be Jim and I.
Jim. Oh, that's right.
He doesn't really know yet. We're going to
He doesn't. We're gonna ask him.
Well, he knows now if he's watching.
He's probably not watching. All right, everybody, have a fabulous weekend, and we'll see you next week.
Thank you.
Bye.